have Brad Thomas because Brad Thomas is an expert of REITs, and he is the CEO of Wide Moat Research, and as well as the author of the Intelligent REIT Investor. And prior to that, he showed me that Sam Zell is actually on the testimonial in the back, which is pretty cool. So you know what, before we start anything, if you could give us the elevator pitch of what your business is about, and then we'll start digging into all the exciting stuff.
Sure. Well, everything is really rooted in real estate. Of course, Isha, thank you again for letting me be on the show. And that's why my background is, of course, in real estate. I spent 20 years as a developer up until this event called the Great Recession, which I'm sure you and many of your audience are familiar with that. And so that allowed me to pivot. I pivoted in 2008 and 9 and 10 and started to write and publish content on a number of sites. Today, I currently publish on Seeking Alpha, as well as Forbes and the Property Chronicle and some others as well. But I provide REIT, real estate investment trust research to really thousands of investors around the world. So it's very exciting, and try to helping to educate investors on this very, very important asset class.
Very important. We want to hear a lot more about it. But you know what? First, let's dig into your story. How did you start with real estate? What got you to, get into this whole thing?
Sure. Well, of course, it's probably part of it is that my DNA, my mother, and actually my father and grandfather have all had a past in real estate. My grandfather used to own motels, not hotels, but motels in Myrtle Beach, South Carolina. He actually had the first motel with indoor color television, which was pretty interesting back in the 60s. And then my mother has been in residential real estate for around 40 years, and she has been on site sales for many large home builders as well as regional home builders. And I got my real estate license when I was in college. I think I was 18 years old at the time, and got my real estate license, went to work in leasing, and that led me into a career in development, primarily in the Southeast. I built stores for many chains like Advance Auto Parts and CVS and Walmart around the Southeastern U.S. And then, as I said, in the recession, I was really forced to change careers, but I stayed in real estate. And now I really love what I do. I have a passion for real estate, but really helping educate investors. Principal preservation is really important for me. I mean, I've lost a lot of money due to recession and other things. And so we try to avoid losses and build wealth using real estate, and specifically, again, real estate investment trusts.
So it sounds like, sometimes we say that, the experience is called a comb that we have after we get bald. And thank God you still have hair, and me too. But I'm saying a little sober. But I'm saying, in terms of the experience, if you could go back to the recession, to the 2008, you're a developer. You're involved in several asset classes and several types of businesses and several types of deals that you're getting into and going out from. What's happening that you decide, boom, I have to pivot?
Yeah. So again, I think it's really been interesting to learn about real estate really from the ground up, and learning how value creation takes place from site selection to permitting, to hiring contractors and architects, to actually collecting rent checks, which is the most important part of commercial real estate. And so, having kind of firsthand knowledge of this, spending over 2 decades of my life learning how buildings are built and really how the value creation takes place, understanding what a cap rate means, all of those things that we all understand in the commercial real estate world. So in 2009, look, I probably, in hindsight, I probably could have predicted this black swan called the Great Recession, because what I found interesting was in early 2000s, I was building shopping centers. I had really grown from building net lease freestanding properties to building shopping centers. And I noticed it was just way too easy to go out and build retail space. I would go to these markets, and a lot of these were tertiary markets around the Southeast, had small populations, 30, 40,000 people in the county. And I would build shopping centers. It was just so easy. I could spec build. Banks were just throwing money at me just to build. And we'd go out to these trade conferences, specifically the ICSC in Las Vegas. I'd go every year, year after year, and I'd always come back with deals. And PetSmart, Barnes and Noble, Office Max. I mean, the list goes on. And it was just so easy. And I knew then, but I wish I'd have known that it was just something was wrong. I mean, the retailers, the amount of money that was being funneled into the retail sector was just massive. And so it really was, again, in hindsight, looking back at this, the fact that, our retail space in the U.S. is extremely oversupplied, and specifically the mall space. I never built a mall. We certainly cover malls today, but the amount of overbuilding in the U.S. was really insane. So, and now with the pandemic, now we fast forward, to the global pandemic and COVID-19, and we can see now very clearly that there was way too many malls that have been built in the U.S., as well as theaters and a number of other retail establishments. Now, obviously, the acceleration of e-commerce has really been beneficial. COVID-19 has accelerated the pace of closures, store closures, but also increased the ability to shop online. So anyway, it's really been interesting. But looking back again, as I was a developer, I can now see, how easy it was to go build a shopping center back then. And now we're, of course, seeing all the painful, closures and store closures. So we definitely cover this space very closely and have a pretty good working knowledge of the retail sector today.
You know what? I'm so happy that you raised that. And retail is one of my, it's a very interesting subject. And I would separate, if you agree, between the 2008, the Great Recession, what we call, to the Amazon, revolution, okay, which brought the e-commerce revolution and to all those shopping centers and the whole retail sector to come and say, okay, we have to rethink everything. And those who came and pivoted, like Walmart, like Target, like those guys, I'm not even mentioning others, but they have made it. And those who didn't, like, J.C. Penney's and the Sears, like you mentioned, Kmart, they didn't. But going back to the 2008, you as a developer of malls, shopping centers, all that stuff, what do you experience? And meaning in terms, you told us about 2008, but the difference between the recession, which was a subprime recession, we know what happened to the banks. It's a debt type of recession that caused a whole tsunami, versus the e-commerce, which came a little bit later. It came in phases, but it sort of, happened a little later. Could you share with us a little bit of that experience? Because you were in it.
Yeah, for sure. Look, it's extremely disruptive. What we've seen before COVID and now after COVID, and in continuation of where we are today. This very fact that you and I are communicating using this very powerful technology, Zoom, and so forth, it's really been amazing to see how technology has really impacted the real estate sector. We do cover prop tech companies. I'm not specifically the analyst over that, but I decided to add prop tech coverage to our collection of research products because, frankly, many of these large public companies that I cover, companies like Simon Properties, companies like Essex, companies like Extra Space, most all of these big real estate landlords have really embraced technology as a means to grow their business and create shareholder value. So it's extremely relevant. The technology aspect, the intersection of this technology in real estate is really critical. In terms of retail, you've heard of the word omni-channel, which is basically a way to describe the various different funnels or distribution points for retailers today. So whether it be a mall location, whether it be an outlet location, whether it be a shopping center location, or whether it be an online location, I think all of those are relevant. And I think the successful retailers must embrace the entire omni-channel world in order to be successful and survive and as well as thrive. So I think it's very important to see, and when you look at the retailers today, you can see the ones that are actually doing well have done just that. They have their critical mass brick and mortar locations. They have some outlets, which I believe outlets they do serve a valuable purpose in that omni-channel. And it's the low cost point, obviously cheaper rent to rent an outlet location. And then the e-commerce channels and how these products are distributed to the end consumer. And I think it's really interesting to see companies like Kohl's, who now have this partnership with Amazon for drop-offs. And I think that's another really interesting part of this disruption that we're seeing out there. But I still believe brick and mortar is certainly relevant in retail. We cover the malls, although there aren't as many mall REITs to cover today due to two bankruptcies now, thanks to COVID-19. But again, that really all boils down to, it's really the fact that there were way too many department store locations that were built. And so we're seeing those numbers shrink. Now, the health of the retail market today in the US is actually not that bad. If you really factor out the department stores, which are, again, we just had too many, Sears and Pennies, again, you mentioned, but you look at those other retailers, the mid-size to small retailers, they've actually done pretty well. And if you think about a department store today, what is a department store? It's really a collection of brands within that department store. So when you walk into a department store, you're going to see, Ralph Lauren, you're going to see Coach, you're going to see, Prada, whatever, all the brands that exist. So now you're starting to see, and we've seen this now, but now it's becoming very clear as the department stores shrink, those companies are leaving the malls, but they're going into either their freestanding locations or outlet locations, and certainly going online to put their brands out. So again, the old traditional department store is really dying. I mean, if there's not really the death of retail, it's really the death of the department store. And so you're seeing, again,
I agree with that.
Those successful retailers are being able to operate off all these channels in order to be successful. So it's definitely an interesting space for sure. And I think it's creating a lot of redevelopment opportunities and a lot of repurposing of malls where you can go in and either demolish the mall or demolish part of the mall to create, a mixed use type of product. But at any rate, I think you definitely are seeing that transition. And I think that acceleration or really rationalization of mall space in the US right now.
So, you know what? So interesting. But, let's go back for a second. What was the point when you said, that's it, I'm out of that, and I'm going into where you are today, which we're going to speak about in a second. And REITs, meaning shopping center REITs, meaning also the whole thing of retail is also within the REIT sector. So we'll talk about that too. But in terms of your experience, when was the point, again, that you said, okay, no more for me on that?
Yeah, well, I don't think it was my decision. So my partners at the time were very successful home builders in 2007 and 8. They had actually sold their previous company to Pulte. They had already done several monetizations, if you will. They were regional home builders. And so I was working with them to create a commercial division of that company in 2008 and 9. And so I can remember those days vividly where, the company had over 500 houses up and running on the ground, either slabs poured or all the way up to the vertical walls being built. And so when the recession hit, it completely just wiped it out. It was like literally like a tsunami. And so I'm sitting there thinking, well, there's it's going to be hard to what am I going to do next? And I started writing on this website called Seeking Alpha, which is actually based about 1 hour from where you're sitting there in Tel Aviv. And I didn't know anything about Seeking Alpha at the time. Just thought, to me, I thought it'd be good to get myself published and write an article. I just thought I'd try one article, and then I wrote a couple more articles. Now, 3,000 articles later, 10 years later, I just celebrated a week or two ago, my 3,000th article on Seeking Alpha. You do the math, that's about 300 articles a year.
Wow.
Essentially one a day, 5 days a week. And I pump out the content, and I've got over almost 100,000, just under 100,000 followers. And that was really as I started to build this, I could see more demand of investors who really wanted to understand, how to deploy in real estate, and learning from somebody who had actually gone through several cycles and understood, the experience of losing money. And so that's really what drives me, is not as much to make money for myself, but to make money for individual investors and really help them avoid a lot of the pitfalls that we see in real estate. And right now, I've just written an article recently about some of the risks in real estate and in REIT investing. And of course, you're very well familiar with the inflation risk and rising rate risk. And I've addressed those in this article that I wrote recently. And, REITs have actually performed very well in previous cycles. So the great thing about the asset class that I cover is REITs have been around a very long time. Actually, since 1960, the laws were passed during the Eisenhower administration. So there's a lot of history that you can go back and see how REITs have performed over multiple decades.
You know what? Now that I wanted to tell you, let's shift gears and talk about a little bit of REITs, which is your field today. A lot of people are familiar a little bit with multifamily, and that's where I come in and try to educate, a little bit more complex things, maybe mixed use, maybe development, maybe retail, maybe industrial, all kind of things that are exciting, the hospitality sector. But the whole thing that is called REITs is less spoken because it's more connected to the stock market. Everybody sees it as something more liquid, which is obviously the advantage of REITs, right? But there's a huge difference between the whole investment via REIT as opposed to go and invest directly into an asset. Can you educate the people who don't really know what REITs are? What is the major difference between a REIT and how does it work?
Sure. Well, you've already learned something because you pronounce it right. It is REIT, so that's correct. And look, at the simplest form, REITs were formed, again, as I said, during the early 1960s, during the Eisenhower administration. And the purpose for this law was actually to help individual investors, not big corporations, not institutions, but individual investors, average Joe and average Jane. And so that's why the laws were created, so that institutionally held commercial real estate could be owned by individual investors. And so when the industry started in the early years, we weren't familiar with many of these property sectors that we have today, which we can talk about those if you'd like later. But we had the basic kind of food groups, as I like to say, which is multifamily. You mentioned that. We have retail, we had industrial, and that's really about it. And now over the years and really decades, you've seen basically every type of real estate today can be securitized and put into a REIT wrapper, if you will. So we even have sectors such as prisons and cell towers and data centers. Any property today could really be securitized. But back to your point, the company has to qualify as a REIT. The company really has to do a couple of things. It has to distribute, it has to own real estate. 75% of the assets have to be owned or controlled. It could be leased properties. That's an important number. And then the other rule, which is probably the most important for REITs, is that a REIT must pay out at least 90% of their net income. And that's why REITs are so attractive, especially for retirees or fixed income investors, because the yield, the distributions are much higher than a C corporation or another company that doesn't have those same tax advantages. Now, to be clear, because I get this a lot, I've heard the argument, well, REITs don't pay taxes. Well, that's true. REITs, the whole premise of REITs is they've created these corporate structures, again, tax advantaged. So the dividend, majority of the income goes directly to the investor. And guess what? The investor who collects the dividend, they certainly have to pay taxes unless you're in a tax advantaged account. So it's a great tool. It's a great mechanism. It's survived multiple decades. It's a very large space now, over $2 trillion today, which, by the way, only represents about 10% of all institutionally owned commercial real estate in the U.S., which means that this space has such an enormous growth pipeline of opportunities going forward. So we think it's really over the next 10 years. I don't know how large this industry is going to be, but it's going to continue to grow and grow and grow. We actually are covering 2 new REITs as of the last week. We had a shopping center REIT list called Phillips Edison, and we had a medical office building list. So we're still seeing a number of new players coming into the REIT sector. So but those are the 2 things to remember. And again, it's all really dividend focused. This is an income-oriented business, and the companies must pay out at least 90% of their taxable income in the form of dividends. And again, that's the attraction to the space.
Tell me something. I'm as you speak, I'm writing down things that I'm thinking of asking, and have an idea of, you know what, REITs have an advantage, and also, like every other sector, they have some disadvantages, I'm sure. Could you say what would be different from if I have, let's say, $100,000, which, in REITs, everybody can actually put in almost any amount. But let's say $100,000. Purposely, I'm saying this amount, and I want to put it into a multifamily core plus type of deal, income producing, meaning that will have 8%, maybe it could go up to 10%, an IRR of 15, whatever it is. Okay. And I'm taking into consideration the cash and cash, the refi in the middle, the sale in the end, like the exit strategy, the whole thing, right? And then there's the REIT. Where is the advantage and the disadvantage of REITs versus those classic type of investments?
Sure. Well, again, the good thing is you're speaking to somebody with experience on the private side and the public side.
Yes.
And obviously I'll say, I'm very, very clear for the record, I'm very biased for the public side for these reasons. Number one, and then again, this goes back to my career of a developer and investor in the private business sector. Number one, diversification. Part of my downfall was my previous business partner. We weren't diversified. We had all of our eggs in one basket. We had one partnership. We were very limited geographically to where we were focused. And predominantly the portfolio we had built, which is around $100 million, was retail. So the great thing about REITs is you can spread your risk across many different property sectors. And you can determine, based on your risk tolerance, which of those sectors are most appealing to you. So for example, one of the most defensive property sectors that I really love, and I used to develop these quite a bit when I was back in the day, were freestanding properties. We call them net lease properties. They have long-term contractual leases. Companies like O'Reilly Auto Parts, Advance Auto Parts, Walgreens, et cetera, Tractor Supply. It's a massive space, and that space, that sector is very defensive because they have the long-term leases, and you can pretty much count on those rent checks to come in regardless. So we try to put a lot of investors, especially the more risk, with lower risk tolerance, into those sectors where you've got very reliable and predictable income. And so again, diversification is important. Some investors, we just started covering cannabis. Again, a new sector. We've got a cannabis, actually 3 companies that focus specifically or exclusively on cannabis. And so, those companies have higher yields, but there's more risk. But again, there's more opportunity, more for reward. So the key, diversification, liquidity you touched on. I mean, it only takes $1 a share to buy, $1 to get into the market. You can even split up shares, buy half a share or whatever, all these services now, Charles Schwab, it doesn't take very little amount of money, but they're liquid. So let's say, for example, that $100,000 example that you mentioned, if I've got 100,000 in REITs, and say, I've got 5 kids, by the way. So let's just say one of them.
I'm here.
Yeah, good. We got a basketball team then. And so let's say that one of my kids, we got braces that I've got to fork out, $6,000 tomorrow to buy a set of braces. Well, I'm going to go sell something. You go try to sell it in the private side, good luck. The liquidity, you got to hire a broker. You got to find a buyer. They've got to get financing. So liquidity is very lumpy in the private sector. In the REIT sector, it's not. Liquidity is hit the button and you sell and there's your money. So you get your money. That liquidity is important, especially for the older generation who, again, if you need that money. For younger generation, obviously they have longer term to accumulate their wealth. So you got liquidity, you got diversification. Next one is really a big one for me. It's transparency. When I was in most of my partnerships, I was not the managing member. I was not in control. It was hard for me. I had to beg to get, the K1s for the partnerships. And I was like, this is ridiculous. It held up my tax filings, all of that stuff. It was a mess. And so great thing with the REITs, they're not K1s, by the way. These aren't MLPs, master limited partnerships. REITs distribute pay 1099s. And so that's really critical, but not only 1099 feature, but just the transparency. Because it's public, we have SEC guidance. SEC doesn't mess around.
You have to have a prospectus, the whole thing. Yeah,
exactly. So that transparency is really important. And then the fourth thing, which I think is also another critical, is management. So management, and again, we interview, just like you're interviewing me, I interview CEOs every week. Sam Zell is one we mentioned, but I have all types of CEOs, and we really drill down to these companies because you've heard the old saying, when you buy a stock, you're not only buying the horse, you're buying the jockey. You've got to know who's running that company, but you have, in large part, especially in the public REIT space, you have very professional management teams who are running those properties, and they're running those properties to create that shareholder value, which is really the important part of this. So management, having professional management to run these companies for you, is really important. So those are really the primary kind of four pillars or attributes that I would say differentiates REITs from the private side. And I will say, we've done numerous studies. REITs have outperformed private equity. And I will say that again, REITs have outperformed private equity, not every year, but over the long period of time, REITs have outperformed the private market. So it is the number one asset class. When you go back over 5, 10, 15, 20, 25 years, you'll see the REIT numbers have outperformed, not only just on the private side of real estate, but most every other every other asset class that you can invest in today. So it's been a very reliable space, even through the pandemic. Because again, this is my first pandemic. I'm sure your first pandemic, we've gone through, and we're still kind of living through the tail end of this, hopefully. And, REITs have actually rebounded quite nicely, with the exception of the malls, which we touched on, and retail, which has been hit hard. The office sector as well. I'm going to throw that in. Office is starting to recover, but we still have challenges, especially in urban markets. But for the large part, REITs have actually recovered and are performing well, and dividends are back to normal. So we've now gone through recessions and now a pandemic, and REITs are still doing very, very well today.
Thank you for this coverage. Let me ask you this. There's one item that's been discussed that the private sector still have an advantage over the REITs. Agree with me on that it's the capital gain over this, the exit. Meaning when you own a REIT, meaning you get some, you lose some. And you get on the end of actually investing in a REIT and having the ability to actually exit out. Like you said, push a button and your money is yours. That is one humongous advantage. Nobody would argue that, okay? Now, this is probably the largest advantage, okay? It's as big as it's like the elephant in the room. Many times, as you said, you put money into some investment and then you want the money back for whatever reason. Good luck with that. Good luck with that. Whether it's a private equity, whether it's, direct, doesn't matter. You'll have a very hard time to get your money back. And with the REIT, just push of a button. Having said all that, you're going to that, aspect of having the exit on the deal. You sold the deal. Now everybody makes the big money. That's when you don't make the money on the REIT side. So
well, again, I agree with that. I mean, I've had those nice windfalls as a developer myself. Certainly there's that is an aspect to consider, but I'll also say there's some legislation coming down the pipeline now that is going to make it, could make it less attractive for investors in the capital gain side, and specifically in the 1031 space, where I've spent a lot of time. I know
This
you
is
have
something.
too.
This is something that everybody's is shaking. He's shaking.
Yeah, we've been watching it very closely. I think I guess my comment on 1031s, we're probably as close as we've ever seen to losing the 1031, but from what I'm hearing, it's not going to happen. We're going to keep the laws in place. But again, I have no direct line, just talking to a lot of the lobbying people that are involved. And as you know, it's a very large industry. I've got hundreds of friends who are, in this industry, whether they're attorneys or brokers. And so, I think the 1031 is definitely an interesting topic. I wish I knew which way we're going to go with it, but it is certainly a way it's one of the tools that we have in the real estate world and again, you know this because I'm sure you've even had shows about 1031. This is not a loophole. At the end of the day,
it's real.
The asset eventually does get monetized. It may be the second or third generation, but the taxes do eventually get paid. There's a substantial amount of revenue that goes into this industry, and so I really hope it stays. Now, I will say this, back to REITs. REITs have what we have called as an UPREIT structure, and I discuss this, write about this in my book, where if you're an individual owner of a private property and you want to trade your asset into REIT shares, you can do that using the UPREIT structure, which operates very similar to a 1031 in that you could sell the property to the REIT and take shares in the company, and that is not a taxable event until the shares are sold. So it functions much like a 1031. And again, that's another REIT attribute for the REITs have versus the private markets.
Very, very interesting. Tell me something. When you when you want to come to your investors and say, listen, I would like to give you, obviously, I don't know how much you're limited to the giving advice or consultancy, whatever you call it, but how would you differentiate from a REIT that is successful than one that you would say stay out of? How do you analyze those? Meaning, what's your
that's a great question. And again, if you mentioned my book, The Intelligent REIT Investor, and if you take out the word REIT, the Intelligent Investor is Benjamin Graham, and probably one of the most successful value investors of ever.
Yes, Warren Buffett's guy.
Correct. Yeah. And so we analyze companies very similar to how Ben Graham did, and now how Warren Buffett does today. And Warren Buffett does own a couple of REITs, not many, but his firm, not Buffett, Berkshire Hathaway, has made investments in REITs. But we analyze those companies much like Berkshire Hathaway or any traditional value investor, and we focus on first quality. That's number one. So before we even get into the price, we don't even look at the price of the company until we take a very hard look at the business model. We check under the hood and we break this company down, and just like we would a car, if we're going to buy it, and we don't just kick tires. We look at the company inside and out. We want to make sure that the quality standards are there. So how do we define quality? Well, we look at the company's balance sheet for one. Cost of capital is really important in real estate, especially in the REIT sector. So we want to make sure the company has a very attractive cost of capital. We like for them to be the low cost provider, the lowest cost company out there, like a Walmart in traditional C Corp space. So companies that have A-rated balance sheets are really important, or certainly investment grade balance sheets. There are quite a few REITs that do have triple B or greater, or double B, triple B or greater ratings. And so again, cost of capital is really important in terms of our quality. We also look at the company's earnings, which of course in REITs we use the FFO metric, which I guess the main difference to traditional earnings is we have depreciation in real estate. So we make sure that's factored in, and we want to see those earnings grow over time. Even through COVID, it's been interesting. We've seen a lot of REITs have had to, adjust their earnings or lower their earnings in 2020, but we're seeing that ramp back up now. We're right in the middle of earnings now with the second quarter, but we're starting to see a number of REITs. In fact, most REITs so far have reported really nice rebounds from their 2020 numbers in terms of earnings. So earnings is very important. And then, how the company has grown the dividend. I mean, dividend is really the paramount, going back to, as I said earlier, the REITs must pay out 90% of taxable income. But we want to make sure they're not only, paying out the dividend, but they're growing that dividend. I mean, dividend growth is really a really big part of what we're looking at, is making sure the company is not just paying out some kind of high dividend yield. We call them sucker yields, 10, 11, 12%, too good to be true. We want to see that company that is paying out a stable dividend, that's growing that dividend, because dividend growth is ultimately extremely correlated to superior, strong total return performance. And so, again, balance sheet, earnings, dividend, we look at the management, we look at, make sure there's an alignment of interest. We want to make sure that the company has invested in the company, the management team has invested in the company. We also want to see, again, another really good sign of alignment of interest is the company's paying that dividend and growing it. To me, that's one of the most important messages you could send a shareholder back from the management team, is that they're paying that dividend on time and growing that dividend. And so we look at all of those factors together. We actually put together a quality score of each company within our coverage spectrum. We have about 150 equity REITs, as well as commercial mortgage REITs. We cover those, about 15 as well. Companies like KKR, Blackstone, Apollo, Starwood, on ladder. So we look at those companies, look at the quality. Then after we decide, hey, this is a company we want to buy. This is the BMW, not the Buick. And I like Buicks, but we want to have the highest quality, company. So we like the BMWs, but we want to buy it at the price of a Buick. And so we then would go to valuation, and we look really hard at the company in terms of the price and the margin of safety, which is really the quintessential reason that Ben Graham wrote this book, The Intelligent Investor, is because it was about the margin of safety. That's the best way to mitigate risk. You don't want to overpay, just like you learned and I learned in the real estate world, private world. You make money when you buy. That's the key. Buy low,
Exactly.
sell high. So we want to buy the shares as low as possible. Again, we want to focus on quality. We're not going to buy a cheap stock. It's cheap for a reason, right? We know many of those deals that are out there, you buy them and, oh man, this is a great deal, but it ends up being a lemon. And we don't want to buy a lemon. So we look at the quality, make sure it's not a lemon. And then we really focus hard on the valuation and make sure there is a quantifiable margin of safety that we can achieve if we buy those shares today. And by the way, we've got a portfolio, our primary portfolio, we call the durable income portfolio. It's generated 28% returns annually since 2014. And that's really the root of our whole business model, is focusing on quality first and valuation.
Tell me something. You just mentioned like the 10 commandments, not the 10 commandments. It sounds, I'm Orthodox Jew. So we have 613 commandments. So it sounded like that. So you mentioned pretty much all of it, from valuation, from earnings to obviously within that's not over leveraged, to make sure that there's enough equity, and there's also, cash that is substantial. Basically, you're looking at everything that is important in the company. Could you please give us an example, a fake example? Let's take a REIT, a fake REIT, without mentioning, we don't want to just give it, advice to people about a certain investment. So let's just make up a REIT. It's called, I don't know, Pinocchio, who cares what? And let's give, meaning, walk us through. What are you going to look at exactly in numbers, and just give some ideas. Okay, I see that the debt is this. I see that this is the equity. I see that these are the earnings. I see that this is a red flag. This is not. Could you do that? Like just.
I can do that. We don't have to use.
I mean, we want to have fun a little bit. That's the whole purpose of this whole thing.
Yeah. So let's use, instead of Pinocchio, let's use not a fake one, but a real one. And then I'll just disclose, since we're on the record here, I do own shares in this company, and it's actually my largest holding, a company called Realty Income. Okay. I know about this company. I can probably go to sleep at night and I know everything there is about this company. I know it in my sleep. I used to So this is Realty Income their ticker symbol is O. There's only one letter. It's called O. That's the ticker if you want to buy it. And again, I do own shares. I'm the largest. That's my largest position.
I just have to disclose. I'm not advising anyone to do anything. So
right, exactly. But I want to explain to you why I've bought this company and why I will continue to buy this company. Realty Income is a triple net lease. When I was a developer, I sold buildings to Realty Income. I used to build for Blockbuster Video, built over 20, 30 stores for Blockbuster, and I would sell stores to them. They don't own any Blockbuster today. They have evolved now to because of their cost of capital, and we'll talk on that in a second, and their scale, they've become a very dominant player in the REIT space, and really not only REITs, but just in the investing world. So Realty Income has been around for about 40 years, but they've been public for about 27 years or so. What's interesting about this company, and the reason we have a very high quality rating on this company, is because they have paid and increased dividends every single year since they went public. There's not one year through multiple recessions or now a global pandemic that they have not increased that dividend. So that makes them part of the very elite dividend aristocrat universe, which is an S&P ranking. So they're a dividend aristocrat, 27 years of dividend growth. In 2020, they were one of the few net lease REITs that actually had positive earnings, AFFO, which is their earnings on 2020. So they were able to still continue to grow earnings and that dividend. Now they've become a very large company because the two levers that are really important are, again, cost of capital and scale, and they're obviously correlated. So they're using their low cost of capital driven by their investment grade A-rated balance sheet. Their cost of capital today, and like a 10-year, it's this ridiculous how low the interest rates they're getting on the money. Again, and this is unsecured paper. So we're talking unsecured. Again, that's one thing private guys can't do. Go out and try to float up, A- rated, deal. Good luck. So they've got very low cost of capital. Their equity cost is also relatively cheap. They're trading right now at about $71 a share. So I would just back of the napkin, their weighted average cost of capital today is somewhere probably below 4%, maybe 3.5% to 4% weighted average cost of capital. So let's put that into the context of a deal. Realty Income can go out and buy a portfolio of, name it, investment grade rated 7-Eleven. So just name a tenant. And they can probably transact at a cap rate of something like 6 to 5 3/4. So the investment spreads, which is really, that's how the company creates value. It's that growing those profit margins. Their investment spreads are somewhere around 200 basis points, and they're buying investment grade properties using their investment grade balance sheet, and they're able to continue to grow and just consolidate this thing. It's like a snowball going downhill. They just announced in the last month or so a pretty transformational acquisition of a company called REIT, which is another publicly traded net lease REIT, which is going to give them extremely big, much more scale advantage in their marketplace. So they're a dominant player in the industry. They're the largest net lease REIT in the world. They're also in Europe now as well, investing there. So they're the largest net lease REIT in the world, growing earnings, growing dividends every year, using their low cost of capital advantage and their scale advantage. So again, looking at how do we evaluate those, we break down all the pieces. We look at the portfolio. Now there's risk to every business. One of the risks that we see with Realty Income is they do have exposure to theaters. Currently, AMC and Cinemark are both in their top 10 list. Now we saw what happened in 2020. Now, as I said, I knew theaters were overbuilt even before the pandemic, but now you can see very clearly we don't need as many theaters, especially now. People just aren't going to go back. I'll go back to the movie, but they're just people that are, Netflix has really taken a big slice of that pie. So that is a risk for Realty Income. But again, using that scale advantage, once they close on that REIT acquisition, the top two tenants, theater tenants I mentioned, they fall off that top 10 list. So there's not as much exposure or risk with the theater sector as it relates to that company. So it's all about diversification. They've got tremendous diversification, both geographically, but also from an operator or revenue perspective. And they have low cost of capital, scale. And again, that dividend speaks a lot of volume. And last but not least, Realty Income, they've actually branded the company the monthly dividend company. So a lot of us retail investors love these dividends because they're paid out monthly. And a lot of retirees and again, fixed income investors really like to get those dividend checks every single month. So that's an overview of probably my favorite REIT and one of my largest holdings.
That was great. Thank you so much. You know, before we say our goodbyes, what I want to do is tell everybody how they can, first of all, buy the book and where they can find you. And obviously you guys can look at the, all the links above, below, wherever. But please tell us, Brad.
Sure. Well, I made a real simple website. So you can go to bradtom.com. That's my personal website. Or you can go to, as you mentioned, Wide Moat Research is our company page. And those are probably the easiest way. I am on LinkedIn, of course. You and I met on LinkedIn. You can type in Brad Thomas on LinkedIn or Brad Thomas on Twitter. Twitter is @BradThomas there. And I'm sure it's easy to find me, Google me. And I do have subscription products on Seeking Alpha. That's another great research site. Again, I publish every day there, but a company called Seeking Alpha. And again, based just 1 hour from your chair there in Tel Aviv. So you can certainly just type Brad Thomas on Seeking Alpha.
Awesome. In the book?
The Intelligent REIT Investor Guide. It's available on Amazon. Wiley is my publisher on their website, as well as Barnes & Noble and Target. Obviously, Amazon is the place. We're actually pre-selling the book now, and I think it'll actually ship out August the 8th or first week of August on Amazon. So we're very close and really excited to get this book out. I am teaching out of the book here in September at NYU. It'll be my first class there at NYU, so I'm excited to be teaching out of the book there as well.
Beautiful. Is that the NYU Shack or NYU?
Yeah, Shack. Yes.
Awesome. So you guys heard it. Brad Thomas basically have so much experience, whether it's from being a developer on retail, which is one of the hardest asset classes and needs a lot more sophistication. And then you heard so much about REITs and what do you have to learn about this and the vast of knowledge that he has. And you can get the book and learn a lot more. And if you want to take his course, you can go to NYU Shack and take his course. How exciting is that if you want to do that? But without a doubt, check out the links, check out the website. And Brad, thank you so much for being with us. I really appreciate your time.
I enjoyed it. Thank you.
Thank you. And you guys.